Welcome to the deep dive. If you've been tracking the aerospace sector, you know these financial reports can be pretty dense, but the story they tell, it's often monumental. Today, we're focusing just on GE Aerospace's Q3 2025 performance. We're going to try and cut through all that complexity. We want to understand not just the impressive profits, but maybe the operational tweaks that made it happen.
Yeah, I think it's really crucial we look beyond just the headline numbers here. I mean, everyone knows demand for engines, for services, it's huge right now.
Yeah.
But GE Aerospace is essentially saying they've figured out how to convert that, massive demand into actual output and, importantly, into significant profit. So our mission for you, the listener, is really to get under the hood of that success mechanism, their operating model, the one they call flight deck.
That really is the core question, isn't it? How did they manage a remarkable 44% growth in adjusted earnings per share? And how is this flight deck thing actually driving breakthroughs in areas that have, well, frankly, crippled the industry lately, like the supply chain and engine durability, too?
Well, if you want a sort of masterclass in applying lean manufacturing methodology, but at the industrial scale of commercial aviation, this is probably it. We need to look for the evidence, right? Proof that their strategy is more than just, catching a rising tide of demand. It's about fundamentally changing how they build and service these incredibly complex machines.
Okay, let's start with those financials then, because they really do set the stage for everything else we'll talk about. In Q3 2025, GE Aerospace saw total adjusted revenue jump 26% year over year. That hit $11.3 billion.
hmm And operating profit kept pace, also up 26%, reaching $2.3 billion.
But the number that really popped for me was the adjusted EPS. It just flew up 44% year over year to $1.66.
Yeah, that kind of growth definitely signals acceleration. And, importantly, it seems to be highly collectible profit. Their free cash flow, the FCF for the quarter, was $2.4 billion. That reflects a conversion rate of over 130%.
Right. For listeners maybe not familiar with that metric, 130% conversion, that's outstanding, isn't it? What does that actually mean in financial terms?
It basically means the profits they're reporting aren't just sitting on the balance sheet, tied up in inventory or, accounts receivable. It points to real operational tightness. And financial discipline, too. They're efficiently turning those revenues into liquid, usable cash. That's a huge indicator of, let's say, quality earnings.
Okay. Now, let's talk scale for a second. They're sitting on just a massive amount of future work. Their remaining performance obligation, or RPO, that's the industry term for backlog, right?
Right.
It stands at roughly $176.3 billion.
And nearly $200 billion. That's locked in future revenue.
Ah.
And it's heavily weighted towards commercial engines and services, CES, and also the defense segment, DPT. The key thing is orders are consistently outpacing the revenue they're recognizing each quarter. So that demand curve, it's still climbing faster than they can actually ship product out the door.
Wow. $176 billion RPO gives massive confidence. I get that. But doesn't that sheer scale also present an equal or maybe even bigger risk? I mean, if just one major piece of that global supply chain suddenly gets worse, how secure is that future revenue stream, really?
Oh, it absolutely carries risk, huge risk. But the sources suggest they're trying to tackle that head-on with operational execution. We'll get into that with flight deck. What that RPO does confirm, though, is the long-term visibility they have into their market position. It's quite extraordinary, and the confidence level internally must be sky high because they immediately raised their full year 2025 guidance across the board.
They certainly did. Adjusted revenue growth now expected in the high teens. That's up from mid-teens they projected before. And they hiked the bottom line guidance pretty substantially. Adjusted EPS raised by $0.40 at the midpoint. So the new range is, what, $6 to $6.20?
That's right. And crucially, the free cash flow guidance also climbed dramatically, now expected somewhere between $7.1 billion and $7.3 billion. And look, these raised targets aren't just based on, hopeful projections. They seem grounded in the operational momentum they actually demonstrated in Q3.
Right. The proof is in the pudding, so to speak.
Exactly.
So, okay, let's dig into that mechanism then. How are they taking this colossal backlog and actually executing with such high efficiency? You mentioned the answer lies in flight deck.
Yeah, flight deck. It's their proprietary lean operating model. Think of it as a very specific playbook for the organization. It prioritizes elements in a really strict order: safety first, then quality, then delivery, and only then cost. That structure apparently dictates every decision from the factory floor right up through the supply chain management.
And the results seem, well, tangible. especially visible in the supply chain, which, let's be honest, has been the industry's biggest headache lately.
Mhm.
According to their own reporting, material input from their priority suppliers was up 35% year over year.
That's a significant jump. Shows real momentum building. They also made a point of highlighting that these priority suppliers are now hitting their shipping targets, achieving over 95% of committed volume for the third quarter in a row. That kind of stability, that predictability in material flow, it's the absolute foundation for meeting that huge LEAP engine production ramp-up they need.
We found a really interesting kind of specific anecdote in the source material that illustrates exactly what flight deck means on the ground level. They talked about partnering with a critical supplier, using flight deck tools to solve production issues together.
Right, tools like 5S and standard work, these aren't just jargon, they're powerful lean techniques. 5S is all about organizing the workplace, sort, set in order, shine, standardize, sustain. It makes waste or problems instantly visible.
Okay.
And standard work just means defining the absolute best, most efficient way to do any given task, and then ensuring everyone follows it consistently.
And the result of applying that kind of focus, that supplier, they achieved a, quote, meaningful improvement in first-time yields. And get this, a greater than 2 times increase in their output.
I mean, that's operational transformation in action. They're not just waiting for parts. They're actively getting involved, fixing their partner's bottlenecks, using their own system.
Right. Proactive, not reactive.
Exactly. And when we look at the commercial engines and services segment, CES, the results seem to bear this out. CES revenue grew 27%. Okay. But operating profit grew even faster at 35%. That shows margin expansion. And the major operational win when everyone was watching was definitely the LEPIC engine production ramp.
Absolutely. LEPIP engine deliveries were up an impressive 40% year over year just in Q3. That performance was clearly so strong they felt confident raising the full-year LE delivery growth forecast to more than 20%.
And here's where the operational success really stands out. It's in the service segment. Services revenue grew 28% year over year. Now think about this. That is dramatically outpacing global flight departures. Flight departures were only up about 3% year to date.
Wow.
This is what they mean by the decoupling of services revenue from those traditional flight metrics.
Okay, hold on. How is that huge divergence possible? It seems almost counterintuitive, right? Revenue soaring while flights are only up marginally.
Yeah, it does seem odd at first glance, but it's driven by 3 very specific factors, all related to the current state of the global fleet. First, there's just major pent-up demand. Worldwide, engine shop visits are still lagging 2019 levels. Engines flew hard during the recovery, maybe deferred maintenance. Now operators are desperate to get that maintenance scheduled.
Okay, pent-up demand. What's the second factor?
The complexity of the work itself. These engines aren't just coming in for routine checks. They're coming in for heavier, more complex maintenance overhauls.
Ah, so bigger jobs.
Precisely. They gave the example of the GE90, that's a big wide-body engine. The second shop visits are apparently 60% to 70% heavier, meaning more work scope, than the first visit. That means deeper overhauls, more replacement parts, more labor hours, more time in the shop, all of which drives up the revenue per service event.
Got it. Pent-up demand, heavier work scopes. And the third factor?
The third is strategic. It's the growth of the maintenance ecosystem itself, specifically the ACIP external MRO channel. Maintenance, repair, and overhaul shops outside of GE's own facilities. Unlocking this external capacity is absolutely key.
Why is that so critical?
Because it ensures service revenue doesn't get bottlenecked just by GE's internal shop capacity. It expands the overall market. That external MRO channel, they said, is up approximately 2-fold year over year, and they expect it to reach something like 30% participation by 2030. It also creates a much wider channel for selling lucrative spare parts.
And you can see this operational velocity, as they call it, in things like turnaround time improvements, TAT-P. Total LB internal shop visit output grew by over 30% in Q3 alone. And there was a specific example. The MRO shop in Malaysia apparently reduced engine disassembly time by 30%.
And that's huge for the airline customer, right? Shorter turnaround time means lower operating costs, fewer days an aircraft is sitting on the ground, not earning revenue. Ultimately, it gets planes back in the air faster. Plus, they mentioned new capacity is already coming online. That Zio's MRO facility in Poland just completed its first LEAP shop visits.
And this operational momentum, it wasn't just confined to commercial aviation, was it? If we look quickly at the Defense and Propulsion Technologies segment, DPT, the output there was equally, maybe even more, explosive.
Yeah, the defense side saw unit deliveries up 83% year over year. For the second consecutive quarter,
83%.
which supported strong revenue growth, 26%. and really impressive profit growth of 75% in that DPT segment. So, yeah, the operational success seems to be translating across both major business lines. And this relentless push for operational efficiency, it seems matched by a really strategic long-term commitment to R&D. GE Aerospace is investing roughly $3 billion a year, and a massive focus of that is on durability. You have to remember, for airlines, time on wing, how long an engine can fly reliably between maintenance visits that is directly linked to their total cost of ownership. It's a critical factor.
Right. And the centerpiece of this whole durability discussion right now is the LEP engine. They detailed their roadmap for improving the lifespan of components, especially in harsh operating environments. What was the latest upgrade they announced?
So they're now producing the next iteration of the LE1A high-pressure turbine blade, the HPT blade. That's the component sitting right in the hottest part of the engine core. It takes the most thermal stress. The goal for this new durability kit is a 2x improvement in lifespan.
A 2 times improvement. What does that actually look like in practice for an airline operator?
Well, it translates to an expected 8,000 cycles, that's takeoffs and landings, in harsh environments like the Middle East or India, or up to 17,000 cycles in more neutral environments. And crucially, they stress they're transferring lessons learned from 15 years of GNX durability enhancements directly over to the L8 program.
Okay, leveraging past experience.
Exactly. And the really ambitious goal here is to achieve the same industry-leading performance, the same durability reputation of the legendary CFM56 engine, but on the L8 platform. And they're targeting that by 2028.
Wow. The CFM56, I mean, that's the benchmark workhorse of narrow-body aviation,
Okay.
right? Known for decades of just bomb-proof reliability and minimal downtime. Setting that as the target for LAP, that's a really serious statement.
It's a huge statement. Shows real confidence in the design fixes they're implementing. And importantly, they're applying this same intense durability focus to their next-generation platforms too. The GE9X engine, that's the one destined for the Boeing 777X, is currently undergoing its second major dust ingestion test. And it's already amassed over 30,000 cycles of testing overall.
Yeah, the source material specifically noted this makes the GE9X the most tested engine in the company's history before it even enters service. They're definitely not rushing the validation phase on that one.
No, clearly not. And looking even further ahead to the CFM RISE program, that's the one focused on open fan technology and the advanced compact core development. We actually started dust ingestion testing on the next-gen HPT blades for that program already. They emphasize this is the earliest they have ever initiated this type of extreme environment testing during the development phase of a new engine. It's all about proving out durability, not after the design is done, but during the design process itself, building it in from the start.
Okay, shifting gears slightly to capital allocation. They seem to be balancing this deep reinvestment in R&D and operations, including, what, $1 billion specifically earmarked to expand supply chain capacity.
$1 billion.
Balancing that with returning capital to shareholders, the plan is $24 billion in shareholder returns between 2024 and 2026.
Yeah, that balanced approach signals, I think, strong confidence in sustained future free cash flow generation. They feel they can do both. They also seem to be pretty disciplined with strategic M&A, or mergers and acquisitions. A notable investment mentioned was the $300 million partnership with Beta Technologies. They're co-developing a hybrid electric turbo generator, and they highlighted its potential dual use both in future commercial electric flight concepts and maybe defense applications too.
And ultimately, it looks like the market has validated their current position pretty strongly. The company explicitly stated they are, quote, sold out on both the EAP and the GEnx engine platforms right through the rest of this decade.
Sold out through the 2020s. That's incredible demand visibility.
And recent big commercial wins just reinforce that. Korean Air's largest ever fleet commitment involving a mix of GNX, G9X, and LEAP-1B engines, and Cathay Pacific committing to a total of 35 G9X-powered Boeing 777-9 aircraft. The demand pipeline just looks massive.
Absolutely enormous.
Yeah.
Hashtag tag outro.
So, all right, let's try to wrap up this deep dive. The story of GE Aerospace's Q3 2025 performance really feels like one of successful execution, doesn't it? The exceptional financials, the 26% revenue growth, the 44% adjusted EPS spike, they seem to be the direct result of applying that flight deck methodology, applying it to solve core industry problems like critically unclogging the supply chain, which then translated directly into things like that impressive 40% growth in LEAP deliveries.
I think that's right. The current profitability seems driven by that operational rigor, that execution focus. While their strategic investments, particularly in R&D and durability, are clearly aimed at securing future profitability. And that massive, almost urgent growth we're seeing in services revenue right now, driven by those delayed and heavier maintenance visits, that's providing the high margin fuel needed for that huge $3 billion annual R&D engine. It's a cycle.
Okay, so here's the long-term strategic thought we want to leave you, the listener, with. They are applying lessons learned from current engine fleets like GX, aiming to achieve CFM 56 level durability on LEAP by 2028. At the same time, they are starting extreme environment testing like dust ingestion earlier than ever before on future engines like the RISE platform components.
So consider this. If they actually manage to hit that 2028 durability benchmark on LEAM, and they successfully accelerate the readiness and robustness of next-generation engine components through this earlier, more intense stress testing, how might that fundamentally change the entire aerospace industry? It suggests a future where engines potentially require significantly fewer unplanned shop visits. That could dramatically alter the financial models for airlines, for MRO providers, really across the globe over the next couple decades. Something to think about.